The most important message is probably to individual investors out there, the retail world, that shouldn't feel compelled to have the same kind of concentration as is represented in the indexes. I always say that's an institutional problem. If you're an institution, if you're a fund manager and you are benchmarked against a cap-weighted index like the S&P or the NASDAQ, you're getting your performance tracked on a quarterly basis against those cap-weighted indexes, you are at the mercy of the construction of the indexes and almost by default have to have that similar kind of concentration, other than in a backdrop where they become the worst performers, not the best in a second. If you're an individual investor, you shouldn't feel that you have to take that same kind of concentration. Yes, many investors think I'd like to beat the S&P, but I find with individual investors, the S&P is a convenient benchmark on the upside. But I also think once markets start to do poorly, then a positive cash return tends to be the benchmark on the downside. You kind of can't have it both ways.